Hey everybody, Tom here with Clear to Climb Realty. We are a full-service California real estate brokerage based in Coronado, California, and serving people all over San Diego County. We help clients buy, sell, and manage properties. We also offer all kinds of great information like the stuff we're going to jump into today. I think that the tax benefits associated with owning real estate are widely misunderstood and in some cases just not even known. And I don't want that to happen to you. If you've owned a home for more than a year, you've probably filed a tax return by now, and so you hopefully have some awareness about things like the mortgage interest deduction. I want to go a little deeper today and provide some real numbers to show you what's going on here. And I'll tell you that understanding this made the difference for me and my family when we decided to first buy a home nearly a decade ago. So let's jump in. Let's start with some basics. 87% of US taxpayers use the standard deduction when they file their taxes. The standard deduction is that number that you deduct from your taxable income to arrive at your AGI, or adjusted gross income. For tax year 2025, the standard deduction is $15,000 for a single tax filer and $30,000 for anyone that's using the married filing jointly status. So if you're somebody who is in that 87% category and you have some sort of charitable contributions, you've probably heard that charitable contributions are tax deductible. However, if the sum of all of your charitable contributions and other deductible expenses falls short of either $15,000 or $30,000, you get no extra credit in your tax return for having made those charitable contributions. However, if you can unlock this concept of itemization, well then you get to add all of your deductible expenses, all of your deductions, to receive a bigger tax benefit. In fact, many financial experts assert that maximizing how much of your money you keep is a critical path to building wealth. So said another way, we've got to get out of this 87% of taxpayers that are just taking the standard deduction. We need to get you more deductions, which means lower tax paid and more of your earnings in your pocket. How do we do that? Well, one of the key ways to do it is to buy real estate and unlock these bigger deductions. Let's look at an example of this. Let's say your gross income is $100,000. And for the sake of this scenario, we'll just say you are filing in the single status, okay? You're gonna file your return as a single person. $100,000 gross income. But let's say maybe you're a service member and some of your income isn't taxed. Let's drop you down to $68,000 in taxable income. To calculate your AGI, or adjusted gross income, we would deduct the sum of all your deductions, or the $15,000 standard deduction, whichever is higher. For this first scenario, we'll assume that you are a renter and that you do not have $15,000 or more of deductions or deductible expenses. Therefore, we will deduct your taxable income of $68,000 by the $15,000 standard deduction, and we will arrive at a $53,000 adjusted gross income. Remember, this is for a renter. So on your $53,000 adjusted gross income, we would then go into the tax tables and look up the tax that you owe. In this case, for tax year 2025, you would owe approximately $6,600 in federal income tax. That comes out to about $550 per month. That's what Uncle Sam's going to ask for. Remember, if you paid more than that throughout the year with payroll deductions, you'll get a refund. If you paid less, you'll owe Uncle Sam some money. Now let's look at what happens if this same person buys real estate. So we're going to take the same gross income and taxable income. They're going to come over to the other side here. $100,000 gross, $68,000 taxable. Let's say you buy a $650,000 condo right here in America's finest city, San Diego. So on a $650,000 condo, and let's say you're able to hold it for a whole year before you file a tax return, just to make the math a little easier. If you finance the whole thing, at today's mortgage rates, you're gonna pay $40,000 to $42,000 in mortgage interest in year one. Remember, mortgage interest on the first $750,000 of mortgage debt or acquisition indebtedness, that's tax deductible. $650 is less than $750, so we know we can deduct it all. So when we look at our deductions, we've got $42,000 in mortgage interest, pardon the abbreviations, and property taxes. Those are deductible as well, state and local taxes. On this property, I'm estimating about an $8,000 property tax bill. And so we get to add those together and we come up with $50,000 in deductible expenses just from the two big ones, mortgage interest and property taxes. $50,000 is way more than the $15,000 standard deduction you'd be entitled to if you're renting. And remember, because you've now unlocked itemization, you're using Schedule A as part of your tax return, listing not only your mortgage interest and property taxes, but also any other deductible expenses that you've incurred over the course of the calendar year. But we'll just cap it at 50 for now to keep the math easy. How do we figure out your AGI, or adjusted gross income? Well, we bring our taxable income of $68,000, and then we subtract our $50,000 in deductions. Taxable, deductions, itemized deductions on Schedule A, and we come up with an AGI, or adjusted gross income, of $18,000. Then we'll jump into the tax tables and figure out the tax owed on an $18,000 adjusted gross income for someone who's filing in the single status. That comes out to about $1,800. So maybe your mortgage, your principal, interest, taxes and insurance, and your homeowners association fees, maybe they all add up for the homeowner to more than the rent you'd be paying on the left side. However, there's a $5,000 swing in your favor or more by owning the real estate, because you're only going to owe $1,800 in tax, whereas the renter owes $6,600 in tax. That's a $5,000 swing, $400 a month in your favor, or in your pocket more accurately, that you can go out and invest in other things. This is a pretty simple scenario. If we start to weave in the other tax deductions to which you're entitled, maybe those charitable contributions, maybe some unreimbursed healthcare expenses, the $50,000 gets larger, your tax gets lower, and there's more money back in your pocket. And when you turn your home into a rental property down the road, now we can deduct things like the homeowners association fees, your property insurance, the repairs and upgrades you make on the home, and so much more, further driving down the tax that you're going to owe. Of course, your numbers are going to depend on your income, your mortgage rate, your amount of mortgage debt. All of those factors will result in very different numbers probably than what you saw up here. Hopefully though, you take away from this that the more deductions you can claim on your tax return, the lower the tax you'll pay, and a key path to getting there is owning real estate. We could go into way more advanced strategies and talk about things like the Section 121 benefit or a 1031 exchange. That's not the purpose of today's video. Head on over to the YouTube channel where we've got information about all of those topics and much more. And if you've got a specific question about your situation, your taxes, your home, reach out. I'd love to talk through it with you. Can't wait to hear from you, and thanks for watching. Talk to you soon.